Hello. For my clients that are joining me here today, thank you. I hope you all are doing well and having a wonderful holiday season. For everyone else joining in, it's good to be with you. And thank you for being a part of the Paradigm Life family and for participating in this virtual client summit. I'm Justin Martin, and I'm really excited for this portion of the seminar. We'll be discussing how to create a family banking system with your children and grandchildren. The reason I get excited about this is because my two oldest sons, Andrew and Henry, who are ages 9 and 7, used the family banking system and their personal life insurance policies for the first time this past summer. Let me give you a little teaser into their experience. So here in Utah, we have the greatest snow on earth. And snow skiing is a pretty big deal for these kids. Andrew and Henry really wanted to get their ski season passes to a resort called Snow Basin. And I told my boys if they earned the money for those passes to the tune of $500, then we would get a family season pass to that resort. So my kids sat down with their mom and drafted up a business plan. And they figured out how they were going to earn that money. Now let's fast forward 16 weeks later. Today my kids are up at Snow Basin skiing, but with a new appreciation for their season passes because they figured out how to create cash flow and how to pay for those passes. It's been an incredible experience watching my boys use their insurance policies to create their own business. I'll walk you through the details of that business in our seminar here at the Paradigm Life Client Summit. And in that seminar, we will cover the creation of the insurance policy based around these kids. I'll show you the minimums required, the maximums you can save into those policies, and most importantly, I'll show you the different ways of how to involve these kids in the family banking system. So thank you again for joining me here, and we will see you soon. Hi, thanks for joining me here today in this portion of the Client Summit. I'm Justin Martin. I'm a wealth strategist here at Paradigm Life, and I'm excited to be talking with you today about doing policies on children, whether it be your children or your grandchildren, and kind of walking through the purposes and benefits behind that. I'm going to be using my tablet here. I'm here in my office, and let me just shrink down my webcam here a little bit, and let's dive into this. Let me give you just a little bit of an introduction to who I am first of all. For my clients that are here with me, thank you for joining in. I'm excited to be here with you. If it's been a while since we've met, please let's set up some time. Let's meet together, look at your plan, talk through your strategy, make sure we're still on track with everything. And for everyone else that's joining in, thank you for being here and for being a part of the Paradigm Life family. So I've been involved in the financial industry now for about 12, 13 years. Started out on the traditional financial planning side. So I was working for a large brokerage firm, doing a lot of stock trading, option trading, managing accounts. I also did some real estate investing on the side. And then when 2008 hit, everything came crashing down. And it's the typical story that most of us have experienced and that we hear over and over again. It was a rough time. And I lost, a good 35-40%. But it was also at that point in time when I decided I was going to take a step back and try to figure out a different way, try to figure out a better way to maintain control of my money, to get guarantees on my money, but still allow me to invest in what I felt was good for me, as well as plan for the future, plan for retirement, find a way that I was going to provide for me and my family in the years to come. So I started doing a lot of research 2008, 2009, 2010 while I was in graduate school at Texas A&M getting my MBA. And that's when I came across this strategy that we're talking about here in this client summit, and that most of you have set up on yourselves now at this point. These cash-rich life insurance policies that allow you to bank on yourself, this perpetual wealth strategy. It's been a phenomenal system for me, and a huge game changer since I started my first policy back then. But today I want to kind of focus a little bit on a niche within this, and that is putting a policy on children. Okay? Obviously this is something that's kind of near and dear to me, given the fact that I've got 4 kids of my own, and I'm trying to figure out how how I can help them in the future, not just to give them money and provide for them financially, but also be able to show them a way for them to learn how money works, learn how to create cash flow, and learn how to not be scared of money, but to know how to work with money or make money work for them. Okay? So that's kind of what we're going to be going through today. Now, as a way to start, I want to talk about two of my kids in particular. Okay? I want to talk about my 9-year-old here. This is Andrew. And I want to talk about my 7-year-old Henry. Okay? Now, here's why I want to talk about them. Here in Utah, I'm going to move my screen out of the way here. Here in Utah, we pride ourselves in having the greatest snow on earth. And winter season's coming up. We're excited. The ski resorts are open. And the kids at school kind of as bragging rights, they talk about the different ski resorts they're going to go to and where are they getting their season pass and are they a skier, a snowboarder, etc. Well, my boys really wanted to get a season pass to a ski resort called Snow Basin. Okay, Snow Basin, it's a great resort. It's up a different canyon than where most tourists know to go to. So if you come into Utah to go skiing, you're going to go up to Park City or one of the ski resorts around there. Well, there's other ski resorts around town that a lot of tourists don't go to. Snow Basin is one of them. It's about a 30-minute drive from our house. But my boys, Andrew and Henry, they also have some cousins and friends that's the resort they go to. So my kids want to get the pass there. And not only that, they want to be on the all-star ski team. Okay? So if they're on the all-star ski team, that means they get the official ski jacket. That means they're in the same ski group every single Saturday for 6 hours. And they're really learning how to sharpen their skills with skiing. Well, the price tag on that is $500 for that pass and that ski school. Excuse me, not $500, $1,000. Okay? I told my kids if they wanted to do it, they had to come up with half the money. You know, I pulled the typical dad move and said, you save up half the money and I'll pay for the other half. I didn't think much about it, but a couple days later, my kids and wife sat down with me with a business plan. My kids were going to start a bread bakery. Drew and Hal's Bakery is what they called it. Okay? And they had set up a way where if they got X amount of clients and produced X amount of loaves of bread over the summer, okay, over a 16-week period, then they would have enough money to pay for their season pass to Snow Basin and their all-star ski school. So I said, okay, let's do it. But then I had to remind the boys that they had to pay to set up their own business. They had to pay for their own flour, their own sugar. They needed to get the supplies. They needed to get the bags to deliver them in. And so we figured out a way to do it. And that was, our boys have life insurance policies. We've started policies on them, and they've got cash value built up in them. So my boys were able to take a loan. They were able to take a loan against those insurance policies to fund their bread business. Now let me advance forward 16 weeks. Okay, end of summer happens. We get into October. Their business is closed until the next summer. During that period of time, my boys were able to sign up a lot of neighbors on a subscription where they bought bread every single Saturday for $3 a loaf, or you could buy a la carte and get it for $4 a loaf. But at the end of that 16-week period, the boys had saved up not only the $500 that they needed for their pass, but they both walked away with another $200 in their pocket of extra money that they could put more towards interest on their policy loan. They were able to buy some bubble gum. They were able to buy a few different little knick-knack things that they wanted. And then the rest of it, they donated it to a nonprofit organization called Lifting Hands. It's a nonprofit that sends money to refugee families. Okay? So my boys were able to go through this incredible experience of being able to create a business and use their policies and learn how money actually works. Now, this picture right here, since I have that picture up here, this is what a 9-year-old boy looks like when a client calls him and says, I'd like to order 2 more loaves of bread, and he just got done washing all the dishes. He wasn't too thrilled to get the dishes dirty again. So, Drew and Hal's Bakery, great success, and it was so fun seeing the kids learn how to begin to run finances. Okay? So I want to kind of use their experience and talk through some of the conceptual idea of all of this, talk about the purposes of setting it up, the benefits that come with it, and how all this works, okay? So we're going to start here, first of all, by going through 7 different points of the purpose behind doing this, okay? So number 1, when we set up these insurance policies, and let me bring my camera back down here again. When we set up these insurance policies, like any life insurance policy, it's good and important to indemnify a person's life. Okay? When a person dies, we know there's going to be those final expense costs, the funeral, the casket, etc., possibly paying for time off, possibly paying for some family counseling, whatever it may be. It makes the process of grieving a lot easier knowing that you don't have to worry about the money with all of it at the same time. Okay? So the indemnification of the kids. Okay? Insurability protection. Now, when you put an insurance policy on a child, that child automatically receives what is called a standard health rating. Okay, so the child doesn't go through any kind of a medical exam like you're used to with your insurance policy, where you had to do the blood sample, the blood pressure, the height and weight, etc. With kids, it's just filling out the insurance application, submitting that in, and every child gets a standard health rating. Okay, so for insurability protection, the great thing about it is they have that standard health rating locked in. They've got the insurance. So in the future, if any medical conditions come up, or if your child ends up getting into some type of an extreme sport or gets their pilot's license, which makes it difficult to get a good health rating, or if, heaven forbid, the child ends up getting into any kind of drugs or marijuana or tobacco or anything like that, where they're not going to qualify for insurance or get a poor health rating, the good thing is you've already secured life insurance at that standard health rating. Okay? Now, number 3 here is where it starts to get fun, when we're going to start talking about the accumulation. Okay? So now we're talking about the actual building of this cash-rich life insurance policy. So first of all, we have the preferential tax treatment on the cash value and death benefit. So we know that if the policy is structured correctly, that cash value is growing tax-free, as well as that death benefit is going to pay out income tax-free to the surviving beneficiaries. Okay, so we get a preferential tax treatment there. Cash value, that's your source of liquidity. Okay, so you're putting the money into the policy, and like any life insurance policy, that cost of insurance is front-loaded into the policy. But then we really start to build, we start to see the compounding interest. But if you look here in this cash value, you can see that this cash value is the money that's accessible to you. Okay, in the form of a withdrawal or a policy loan, that's the money that is accessible to you. Now, this example right here is an example of a child that you started putting money into this policy when the child was a newborn, 0 years old. Okay, this is a male child. And this is saying you're putting $250 per month into the insurance policy. Okay, so then you'll see here total premium, the cumulative amount that's adding up. Okay, so $250 a month, this is what it looks like. Now, do you have to start a child's policy at $250 a month? No. No, you don't. In fact, my kids' policies, the first policy that we started on them was much smaller than that. We didn't have a lot of cash flow at that point in time. We were putting in about $60 per month into their policies. Okay, but over time, you build more policies, you add more money, etc. Okay, but this example says you're putting $250 per month into this policy. So what happens with those numbers? You can quickly start to see how time works in favor of that child. I mean, if they're putting in $250 per month, or you're putting in $250 per month, 20 years down the road, they've got $82,000 sitting there. Okay, age 60, if they keep on doing this, they've put into the policy $180,000, and they've got $775,000 with a $2 million death benefit. Okay, so there's tremendous growth that's happening in the policy at that point in time. Okay. Now the last bullet point here, ability to get higher yields in a rising interest rate environment. So what I'm basically saying here is when interest rates are up, we know we're in a very low interest rate time right now, but as interest rates go up, yields on bonds go up. Now investment companies deal a lot with investing in bonds. So as bond yields go up, that means the insurance company will be more profitable, and thus the dividends in these policies are even bigger. Okay, so we like to see that those higher yields are producing that higher interest rate coming back to you. Okay, let's go to the next page here. Let's hit 3 more points. So we've got here control, the ability for the parent to control the policy past the child's 18th birthday. So if you remember back in the day, these aren't touted or sold very often now, but UTMA accounts and UGMA accounts are what a lot of people use. I guess for my generation, when I was born, I'm 34 years old. When I was a kid, my parents were putting money into a UTMA account for me. Okay. But that UTMA account or the UGMA account, when I turned 18 years old, I now can assume responsibility of that money. That's now mine. I'm now an adult. It's mine. Well, with the insurance policy, it might likely be that at 18 years old, that child's just not quite ready financially or mature enough to take over ownership of that money. So you, as the parent or the grandparent or the owner of the insurance policy, when the kid turns 18 years old, if you want to maintain control of the money in the policy, you still maintain control of that policy. Okay? All right. Excuse me. All right, so now we're gonna kind of number 4 and number 5 kind of start blending into each other a little bit. So we have this cash value that's growing inside of the insurance policy. And we want to maintain control of that policy for the child to use later on. Now, if your child's the type of child that's possibly going to college, then great, that cash value can be used. Andrew right here, my oldest child, he's a very brilliant child, just book smart, loves learning, loves education, loves school. He's going to be the type of kid that's going to go to college, go to graduate school, be a JD, MD, whatever he goes into, he's bound for college. So we're building that cash value in order to get ready for college. Now, when he gets to college, there's the possibility of preferential financial aid treatment, meaning this. Currently, on the FAFSA document that you fill out, that a student fills out when they're applying for financial aid from the school, the FAFSA document doesn't ask about cash value. Okay? It'll ask about the parent's net worth, it'll ask about the parent's liquid assets, it'll ask a lot about the parents, but it doesn't ask about what is cash value inside of insurance. Okay? So there's the likely chance of them getting qualified easier for financial aid. Now, if you have a 529 plan, then you have to report that on FAFSA, and it decreases the chance of you getting financial aid. Okay? Now, I say the possibility of preferential financial aid treatment because At a lot of prestigious schools and private schools now, they also have another survey called the CSS profile, where a profile is done on the parents of the student. In that CSS profile, they do ask about cash value and life insurance. So at a prestigious school or a lot of private schools, cash value is now counted into the overall equation. Okay, but again, the cash value, there's that the preferential tax treatment. It's growing. When you use that money, it's tax-free use of that money. Okay, and unlike a 529 plan, this doesn't involve any stock market risk. Okay, when you purchase a 529 plan, when you put money into the 529 plan, you're purchasing into different types of funds, mutual funds built inside that 529 plan. With the insurance policy, again, it's the guaranteed growth and the dividends coming into that policy and building. Okay. Now, my second child here, Henry, my 7-year-old, I don't know if he's bound for college. Okay, he's a very smart kid, but his interest and his personality is a lot more of an entrepreneur, a salesman, a builder. He's always trying to find ways to make money. I think when he's a teenager, he's gonna dive into a lot of our family real estate investing and start to go that direction. So for him, money that I'm saving up for his college funding, I'm still just putting that into the cash value of the insurance policy, because if he doesn't go to college, well, we didn't lose out on that. We can use it so he can build his own business or do something else. Okay, so maintaining that control. All right, moving down to number 6 here. Okay, legacy and gifting. So let me hit gifting first. The federal gift tax treatment allows you to when you're putting money on a child, as a parent, as a grandparent, each person individually can contribute $14,000 total to that child's. That's how much money they can give to the child per year. Okay, just so normal gift tax implications are part of this. But then as that policy is building, as you're putting money into it, that's where you're really starting to build that legacy planning, the multi-generational planning, where their money is growing over time. Let me come back up here again. So their money is growing over time. You know, they're able to use that money, but when this person turns 80 years old, you know, maybe their death benefit is around $4 million, and they've got who knows how much in cash value. But when this child passes away, that $4 million is now going to be set up to fund the policies of the next generation. Okay, so now you're just passing down that income-free death benefit, income tax-free, there we go, that's what I'm trying to say, income tax-free death benefit to the next generations. Okay. Now, there's a whole section here during our client summit that talks about that legacy planning, the trust, and the different ways to set that up. So make sure you jump onto that or talk to your wealth strategist to help you figure out how to set that up, okay? Let me come here then to our last one, the family banking, okay? Last point here, and it'll be pretty quick on this one. So the family banking, you know, when your policies start to grow, when you start to get a lot of money into them, there will come a point in time where your kids are going to be adults. But we all still want to run the same family banking system. So instead of your child going and taking a loan from the bank to purchase their first home, maybe they want to take it from the family banking system, from their insurance policies, your insurance policies. So at that point in time, that's when we need to start setting up some oversight and control. All right, so now there's going to be a family board of directors or trustees. We'll start talking about promissory notes. We'll start talking about, you know, paying back the interest and principal, etc. But now starting to really treat this as a lending business, a family lending business, a family bank, okay, and holding everyone responsible for that. but it's really going to provide a lot of flexibility for you to be able to design it however you want. Okay, whether it's to do real estate investing, or maybe it's you're wanting to use it for charity, or there's going to be a variety of different ways that you can design this. But because there's money saved up in there and growing, it provides you the ability to do those things. Okay? I apologize, I'm starting to lose my voice here a little bit. All right, let me come down here to my next screen. Okay, so how do you actually buy life insurance on your child or grandchild? Well, the first place to go, the good place to go, is an employee benefit. So more than likely, your employer has some type of a death benefit that's offered to all of the dependents of that employee. Typically, there's a $10,000 to $15,000 death benefit. You more than likely have to elect into it, and it's either free or costs you a couple dollars a month to get that small death benefit. So that's one way to get it. The next way, the better way, is to put a child benefit rider on your own personal life insurance policy. So for those of you that already have a life insurance policy set up on yourself, you can elect to put a child benefit rider on there, which typically gives about a $15,000 to $20,000 death benefit in the case that your child passes away. It also locks in that death benefit, so later on, well, it depends on the insurance company, but for some insurance companies, you can actually convert that $10,000 to $20,000 into a whole life insurance policy later on in the child's life, if you choose to do so. Okay? Or when that child becomes an adult, I should say. But the best way to set this up is to actually start the traditional whole life insurance policy on the child now, and to max fund that policy and really get it going. Biggest reason why is time. The child is so young right now, they have so many years to build in that with that compounding interest, that right now is the best time, even if it's a small amount, but that it's starting to build now. Overfund that policy, really get it going. Okay. Then when the child turns 18, if they're healthy and they're living a good life, they can do the medical exam at that point in time to see if they can get a standard plus or a preferred health rating. Okay, so they can always bump up to a higher health rating when they turn 18. So there's that possibility there. All right, let me just look through my notes here a little bit and make sure I covered everything that I wanted to. Again, these policies, when you go to set them up, they can be started very small, they can be started large. Make sure you meet with your wealth strategist, your agent, to talk through the size of it and what'll be best for your situation. Okay. Looks like that's everything that I wanted to go through. So I wanted to tell you thank you again for joining with me here. I will be in my booth on the Client Summit page. So if you've got any questions, I'll be there for about the next 20-30 minutes answering any questions there. Any further questions beyond that, you can contact me here, my contact information, or reach out to your agent, your wealth strategist, to go through any questions, or if you want to be running any policies with them. All right? Thanks again for joining in, and we'll see you guys soon.